Reza, millions of people have been clicking pay in 4 at checkout for years under the assumption it was invisible to their credit. That assumption just became wrong. What actually changed and why did nobody get a heads up?
So buy now, pay later, or paying for, has been exploding, as we know. A lot of people are using it, and that is also a function of the cash flow pressures people are seeing. So paying for actually did not just suddenly start affecting people's FICO scores. What has really changed the infrastructure? So, for example, Affirm began reporting its loans to Experian and TransUnion. The bureaus built systems to accept and receive BNPL data, and FICO created models specifically designed to interpret that data. But here's a crucial distinction: data can appear in your personal credit file without being shown to lenders or included in the score they use. That is where most paying for BNPL reporting sits today, and the keyword is today. That might change. So BNPL has not fully entered the credit scoring system, but the wall that used to exist before is coming down. So it is getting into the credit system now. And there was no universal warning because there was no universal switch. There wasn't just like overnight everything just changed. Every provider, bureau, scoring model, lender is moving to on a different timeline. And you're paying for maybe entering a credit file before it actually enters your credit score. Just know that it's just right there knocking on the door. But it's not through the doors yet completely.
Let's back up. Why was BNPL ever off the grid to begin with? If it's borrowing money, why wasn't it treated like borrowing money?
That was because BNPL grew faster than the credit system could figure out what to do with it. And they just exploded, as we know, in the last 3 to 5 years. Traditional credit models were designed around accounts that stayed open for months or years. That's how it traditionally worked. Paying for can create a brand new 6 week loan, as we know, every time someone checks out. If an old scoring model treated every $80 purchase as another traditional installment loan, a frequent user could suddenly look like they were opening 10 new loans a year, right? So that wouldn't be fair and that wouldn't be right. So that could really punish the structure of the product than the actual risk of the borrower. So that was the reason behind this. So the bureaus just needed a separate lane. The scoring companies needed a separate logic, and providers needed confidence that reporting would not accidentally hurt responsible customers. So that was part of the reason. And that alignment took some time, took some years. TransUnion, for example, specifically segregates BNPL data so older scores do not misinterpret it, right? So there are some guardrails they're putting together. They're cautious, they're careful. And the main reason BNPL wasn't invisible, because it wasn't debt. It was just invisible because the credit system didn't know how to classify it fairly. And that just takes time and alignment, but eventually I believe it'll get there.
Regulators have been sounding the alarm about loan stacking for a while. What does the data actually show about how people use these apps?
This is really interesting because stacking is real, and that is the strongest argument for reporting, proper reporting of these kinds of financial products. The CFPB found that 63% of BNPL borrowers had multiple loans running simultaneously at some point during 2022. This is data they looked at. 33% borrowed from multiple providers. The average user originated like almost 10 BNPL loans during the year. About 1 in 5 users averaged more than one new loan every month. So the danger wasn't necessarily that $100 purchase split into 4 payments was a thing. It was that 5 different apps may each see only their small obligation and nobody sees the consumer total payment burden. And that was really the risk of this thing just kind of exploding without anyone understanding what's going on with the individual borrowers. And that's what worried regulators. Not BNPL by itself, but fragmented debt with no consolidated view. That's really the problem. And CFPB did this study, and it was pretty comprehensive. And so each loan, hence, looks small in isolation. The risk only becomes visible when you all add all the apps together. And without that view, there was no true understanding of a borrower's risk. And that was really behind why this move happened.
So the obvious fear is that everyone who used Klarna or Affirm is about to watch their score crater. Is that what actually happens?
No. So first, no need to panic. Most BNPL activity is still not affecting traditional credit scores today at the moment. And also, there's been study, like FICO studied more than 500,000 Affirm customers to stimulate what would happen under its purpose-built BNPL model, 85% experienced a change of fewer than 10 points. So they didn't think it would. The data showed it really didn't move the numbers that much. That is encouraging, right? But it was control study, and we have to take it with a grain of salt, right? So what BNPL getting reported is, well, it's not a credit score cliff. It is not a disaster waiting to happen. What it is just a financial system building better radar to capture more data. That's all it really is, and that's how an individual person should look at it. It's just the financial system trying to look at better data, and if you're responsible, right, that radar should not catch things that are bad. And so that's the important thing to remember.
So who does need to worry? Who might actually come out ahead here?
So the potential winners are people, particularly consumers with thin credit files who don't have a lot of, trade lines, and for whom reporting a product, payment on a product responsibly is helpful. So it really kind of helps those kinds of people. The people who should be concerned are those missing payments, right? So you should not be missing a paying for BNPL payment, and those are the people who should be concerned, and those who are kind of stacking these kinds of products and not keeping track of it, right? So good BNPL behavior is often invisible. In the future, both good and bad is going to become visible, and that's all really what you should know about this getting scored.
There's a broader pattern here. First it was rent, now it's BNPL. What does it tell people that the system keeps quietly expanding what it watches?
And this is the most important part, right? This is the real consequence, the real insight for all of us, is that credit files are gradually expanding beyond traditional credit cards and bank loans. And rent, for example, is increasingly reportable. BNPL is becoming reportable. Alternative financial data is used for underwriting. And that makes the financial system more inclusive. It makes it more flexible. And frankly, I believe it makes it more fair. But we should also be aware that data is not automatically fair. It must be classified correctly. It must be understood by the models correctly. The consumer needs to know that what gets reported and what makes those inputs intentional, right? So it's about, we're entering a world where the average consumer needs to take control of their credit, not just assume it's an autopilot. Don't wait, for example, to apply for a mortgage to discover that what's been following you. And your credit file is becoming less like a list of loans and more like a record of financial behavior. And make sure it records the behavior you want recognized. And that is the most important lesson coming out of this.
So BNPL is a good example of accidental credit activity. What does deliberate credit activity look like instead, and where does AVA fit into that?
Exactly. BNPL is accidental credit activity. You're out there in the checkout, cart, and suddenly you get offered to pay in full, which is, kind of works out for a lot of people. And you're not really thinking about the repayment risk, whether if you've set up the auto payment properly, what happens if you miss a payment, right? So it's accidental, it just happens. Deliberate credit activity starts with the opposite question, right? It's like, what positive behavior do I want added to my credit file, right? This is what AVA is built around. AVA's credit building products report payments activity to all three credit bureaus. Autopay reduces the chances of missing payments. The credit builder card charges no interest and uses spending limits, so it controls what happens, helps you control what happens. And, results are not guaranteed, but it's all about the right behaviors and the guardrails set up and the composition of the products, the features that help you build your credit history. So the difference is intentional. So one is you choosing a product specifically designed to build credit, and the other is just an accidental thing that happens. It's like, for example, using AVA is like going to the gym, working out, lifting weights, right? BNPL is more like taking a walk, picking up your kid. It may work out. You may hurt your back. You may be in better shape, but you don't really know, right? So that's really the big difference. And the key thing is, when you're using BNPL, you're asking, hey, what can I buy today? What can I afford today? When you use credit building tools like AVA, you're asking yourself, What do I want my credit file to look 6 months from now, a year from now? And that's very intentional. One is intentional, the other is not.
For someone who just realized they have 4 open pay later balances they have not thought about in months, what should they actually do this week?
Look, first, you just have to make a complete inventory. I know it's annoying, it's manual, but you have to make a complete inventory. You have to go through all your apps. You have to go through your bank transactions, look at what's getting paid out, and make an inventory. And second thing is, as soon as possible, bring anything past due current, and don't ignore that you've fallen behind. And if you're falling behind, or in general, just stop opening new plans until the existing ones are paid off. If you need 4 apps to remember what you owe, you already have way too many moving pieces in your life, and life is already complicated. Don't complicate it even more. And the other part is look at your credit report, look what's in it, and deliberately, consciously start treating your credit like your health, right? You have to make the right choices deliberately, intentionally, to have your credit in a good place so that when you do apply for financial products, you get the best rates, you get access to the best terms, and that is the only way to do it. BNPL is the complete opposite. It's accidental, it's not intentional, and you have to have very good mechanisms to track things and not fall behind.